In 2025, the Philippine economy presents a compelling case study for macroeconomic analysis, distinguishing itself within the dynamic Asian landscape. Despite a complex global environment marked by persistent inflationary pressures, geopolitical fragmentation, and uneven post-pandemic recovery, the archipelago nation has demonstrated remarkable resilience and accelerated growth. This video delves into the quantitative and qualitative factors underpinning the Philippines' position as one of Asia's fastest expanding economies, offering an analytical perspective tailored for economists. We will dissect the key drivers, evaluate the policy frameworks, and critically assess the structural shifts contributing to this performance, while also identifying inherent vulnerabilities and future challenges. International financial institutions consistently highlight the Philippines, prompting a deeper examination of whether this growth spurt signifies a fundamental structural transformation or is primarily driven by cyclical factors and policy support. Analyzing the Philippine economy in 2025 necessitates a rigorous examination of key macroeconomic indicators and the projections from leading global institutions. While forecasts inherently carry uncertainty, the consensus among diverse analytical bodies provides a robust baseline for understanding the country's economic momentum relative to its peers. The Asian Development Bank's 2025 outlook positions the Philippines favorably within Southeast Asia. Their projection of 6% GDP growth, while potentially subject to minor revisions based on evolving global conditions, underscores a sustained expansion phase. The ADB's analysis typically emphasizes the demand-side components, particularly the strength of private consumption and the multiplier effect of public infrastructure investment. Their assessment often highlights the resilience of the services sector, which benefits from both domestic demand and external BPO revenues. The slight moderation from earlier, more optimistic forecasts reflects a pragmatic view of potential external headwinds, such as slower growth in major trading partners or tighter global financial conditions, rather than a fundamental weakening of domestic fundamentals. The ADB's ranking of the Philippines third in Southeast Asia, behind Vietnam and Cambodia, invites comparative analysis. Vietnam's growth is heavily export-driven and benefits from supply chain diversification trends, while Cambodia's trajectory is influenced by specific sectoral dynamics like garments and tourism. The Philippines' growth, in contrast, is more domestically anchored, providing a degree of insulation from global trade volatility, but also highlighting the importance of internal policy effectiveness and structural reforms to sustain this momentum. The ADB's analysis often points to the need for continued investment in human capital and infrastructure to enhance long-term productivity and competitiveness. The International Monetary Fund's 2025 growth forecast of 5.5% for the Philippines, while slightly more conservative than the ADB's, still places the country as a top performer in emerging Asia, second only to India. The IMF's analytical framework typically focuses on macroeconomic stability, fiscal sustainability, and external sector dynamics. Their assessment commends the Bangko Sentral ng Pilipinas, BSP, for its proactive monetary policy stance in managing inflation expectations and maintaining financial stability. The resilience of consumer demand, a recurring theme in most analyses, is seen by the IMF as a testament to sound macroeconomic management that has preserved purchasing power and employment levels. The IMF's emphasis on external uncertainties, such as global interest rate trajectories and trade policy shifts, underscores the analytical challenge of forecasting in an interconnected world. For economists, the IMF's perspective highlights the importance of external vulnerability assessments, including foreign exchange reserve adequacy, external debt sustainability, and exposure to global commodity price shocks. The Philippines' relatively strong external position, supported by robust remittance inflows and BPO revenues, provides a buffer, but the IMF's analysis serves as a reminder that vigilance is required, particularly regarding potential capital flow volatility and the impact of global financial tightening on borrowing costs. Fitch Ratings' reaffirmation of the Philippines' investment grade rating, BBB, stable, in 2025 provides a crucial perspective on the country's creditworthiness and medium-term economic prospects from the viewpoint of international investors. A stable outlook at the BBB level signals confidence in the government's ability to manage its fiscal affairs and service its debt obligations. Fitch's projection of 5.6% growth aligns broadly with other institutional forecasts, reinforcing the consensus view of sustained expansion. Their analysis typically focuses on fiscal metrics, including government debt-to-GDP ratios, deficit trends, and revenue generation capacity. Fitch's emphasis on strong private consumption and ongoing fiscal consolidation highlights the interplay between demand-side strength and supply-side policy efforts. Fiscal consolidation, while potentially dampening aggregate demand in the short term, is viewed positively by credit rating agencies as it enhances long-term fiscal space and reduces sovereign risk. The assessment of manageable inflation and stable government debt metrics provides comfort to investors, suggesting that the current growth trajectory is not being fueled by unsustainable fiscal or monetary policies. For economists, the Fitch rating serves as an external validation of the country's macroeconomic management framework and its attractiveness as an investment destination, influencing capital flows and borrowing costs. Beyond the headline GDP forecasts, economists analyze a range of other indicators to gauge the health and quality of growth. Purchasing Managers' Indices, PMI, for manufacturing and services provide forward-looking insights into business sentiment and activity levels. Labor market data, including employment rates, wage growth, and labor force participation, are crucial for assessing the inclusiveness of growth and its impact on household incomes. Inflation data, broken down by components, helps understand price pressures and the effectiveness of monetary policy. Trade statistics reveal the country's integration into global value chains and its vulnerability to external demand shocks. Analyzing trends in foreign direct investment, FDI, provides insights into long-term capital inflows and confidence in the business environment. For 2025, a granular analysis of these indicators would likely show continued strength in services and domestic trade, improving but still challenged manufacturing, and a labor market benefiting from BPO and infrastructure expansion. Understanding the Philippines' growth story in 2025 requires a deep dive into the specific engines propelling the economy. These drivers are a mix of structural characteristics, policy outcomes, and external factors, each contributing uniquely to the overall trajectory. Household consumption remains the bedrock of the Philippine economy, consistently accounting for over 70% of GDP. In 2025, this dominance is sustained by several factors. A relatively young demographic profile ensures a continuous inflow of new entrants into the labor force and consumer market. Rising employment rates, particularly in the services sector and construction, translate directly into increased household income. While inflation has been a concern globally, the BSB's proactive stance has helped keep it within a manageable range, preserving consumer purchasing power. Furthermore, the wealth effect from rising asset values, e.g., real estate in urban centers, and increased access to consumer credit contribute to buoyant spending. For economists, analyzing Philippine consumption involves examining income elasticity of demand for various goods and services, the impact of consumer confidence indices on spending patterns, and the distribution of income gains across different socioeconomic strata. The sustainability of consumption-led growth is a key analytical question. It relies heavily on continued job creation, wage growth outpacing inflation, and effective social safety nets. While robust, this model also highlights a potential vulnerability. Dependence on internal demand can limit export diversification and expose the economy to domestic shocks, such as natural disasters or political instability, that dampen consumer sentiment. Remittances from overseas Filipino workers, OFWs, are not merely financial flows. They are a critical macroeconomic stabilizer and a significant component of national income. Expected to exceed $40 billion in 2025, these inflows represent a substantial portion of GDP, around 8%, and provide a vital source of foreign exchange. Remittances directly boost household income for millions of Filipino families, fueling consumption, particularly in rural and semi-urban areas. Their counter-cyclical nature, often increasing during global downturns as OFWs send more money home to support families, provides a crucial buffer against external shocks. From an economic perspective, remittances have a significant multiplier effect, stimulating local economies through increased spending on goods and services. They also contribute to the country's balance of payment stability, helping to finance trade deficits and maintain foreign exchange reserves. However, analytical considerations include the potential brain drain associated with labor migration, the vulnerability of these flows to economic conditions in host countries, and the challenge of channeling remittances into productive investments rather than solely consumption. Policies aimed at facilitating remittance flows, reducing transaction costs, and encouraging their use for savings or investment are crucial for maximizing their economic benefit. The services sector, particularly business process outsourcing (BPO), remains a powerhouse of the Philippine economy. Projected BPO revenues exceeding $38 billion in 2025 underscore its scale and importance. The sector encompasses a wide range of activities, from traditional voice-based call centers to increasingly sophisticated IT-enabled services, healthcare information management, animation, and software development. Its growth is driven by a large, English-proficient labor pool, competitive labor costs, and improving digital infrastructure. Economists analyze the BPO sector's contribution to employment, particularly formal, urban employment, its role in diversifying exports beyond traditional goods, and its impact on urban development and real estate markets. The sector's evolution towards higher-value services, driven by technological advancements like AI and cloud computing, presents both opportunities and challenges. While AI can enhance productivity, it also poses a risk of automating certain tasks, requiring continuous upskilling and reskilling of the workforce. The sector's resilience during global downturns, as companies seek cost efficiencies, has been a key strength, but competition from other emerging economies necessitates continuous innovation and investment in talent development. The government's sustained commitment to infrastructure development under the Build Better More program is a significant growth driver. Large-scale projects, including transportation networks, subways, expressways, airports, logistics facilities, and digital infrastructure, broadband expansion, enhance the economy's productive capacity. Improved infrastructure reduces transportation and logistics costs, increases connectivity, and facilitates the movement of goods, services, and people. This, in turn, enhances the ease of doing business and attracts both domestic and foreign investment. Analyzing infrastructure spending involves assessing its direct contribution to GDP through construction activity, its indirect effects through improved efficiency and productivity across sectors, and its induced effects through job creation and increased incomes. Economists also evaluate the financing mechanisms, public funds, official development assistance, ODA, public-private partnerships, PPPs, and the efficiency of project implementation. Challenges include land acquisition issues, bureaucratic delays, and ensuring equitable distribution of infrastructure benefits across regions. The long-term impact of these investments on competitiveness and potential growth is a key analytical focus. The Philippines' proactive engagement with green and environmental, social, and governance (ESG) financing represents a significant structural shift and a new avenue for attracting capital. The successful issuance of a $2 billion ESG global bond in 2024 signaled the country's commitment to sustainable development and tapped into a growing pool of global capital seeking responsible investments. This has catalyzed increased investment in climate-related projects, such as renewable energy, solar, wind, geothermal, sustainable transportation, and climate-resilient infrastructure. From an economic perspective, green and ESG financing diversifies funding sources beyond traditional channels and aligns the country's development trajectory with global sustainability goals. It can attract foreign direct investment from companies with strong ESG mandates and stimulate the development of new industries and technologies. Analytical considerations include the development of a robust regulatory framework for green finance, the capacity to identify and implement genuinely sustainable projects, and the potential for greenwashing. The long-term impact lies in building a more resilient and environmentally sustainable economy, which can mitigate climate risks and enhance long-term competitiveness. Beyond these primary drivers, several other factors contribute to the Philippine economic narrative in 2025. A gradual recovery in the manufacturing sector, particularly in electronics and semiconductors, supported by global demand and supply chain adjustments, adds to export revenues and industrial employment. The agriculture sector, while facing structural challenges, is seeing increased focus on modernization, technology adoption, agri-tech, and value chain development to improve productivity and ensure food security. The tourism sector's continued recovery post-pandemic, driven by increased international arrivals and domestic travel, provides a significant boost to regional economies and foreign exchange earnings. Analyzing these sectors involves understanding their specific constraints, growth potential, and linkages with the broader economy. The sustained economic performance in 2025 is not solely a result of inherent strengths, but is significantly shaped by the prevailing policy environment. Effective monetary policy, digitalization initiatives, and efforts to improve the business climate have created a more conducive ecosystem for growth. The Bangko Sentral ng Pilipinas, BSP, has played a crucial role in anchoring macroeconomic stability. Its commitment to an inflation-targeting framework has been instrumental in managing price pressures amidst global volatility. By skillfully using its policy tools, primarily the policy interest rate, but also reserve requirements and macroprudential measures, the BSP has navigated the trade-offs between controlling inflation and supporting economic growth. In 2025, with inflation hovering around the BSP's target, the central bank has maintained flexibility, potentially allowing for a more accommodative stance if external conditions permit, or tightening if inflationary risks reemerge. Economists analyze the BSP's policy decisions based on its reaction function, its communication strategy, forward guidance, and its effectiveness in managing expectations. The BSP's proactive approach to financial stability, including oversight of the banking sector and management of systemic risks, is also critical. The challenge for the BSP in 2025 and beyond lies in balancing the need to support domestic demand with the imperative of maintaining price stability in a world prone to supply shocks and volatile capital flows. The management of the Philippine peso exchange rate, while generally market-determined, also requires careful consideration due to its impact on inflation via import prices and competitiveness via export prices. Government-backed digitalization initiatives are fostering innovation and improving efficiency across the economy. Efforts to expand broadband coverage, develop e-governance platforms, and promote digital payment systems are reducing transaction costs and increasing financial inclusion. Legislation like the Internet Transactions Act aims to build trust in e-commerce, while initiatives like the Startup Venture Fund provide crucial early-stage funding for innovative enterprises. These policies are creating a more fertile ground for startups, particularly in fintech, health tech, and edtech, leveraging the country's young, tech-savvy population. Analyzing digitalization involves assessing its impact on productivity growth, the formalization of the informal economy, and the creation of new business models. Challenges include bridging the digital divide, ensuring cybersecurity, and adapting regulatory frameworks to keep pace with technological change. The success of these initiatives is crucial for enhancing competitiveness, improving public service delivery, and unlocking new sources of growth in the digital economy. Improvements in the regulatory environment and bureaucratic efficiency are critical for attracting and retaining investment. Recent reforms aimed at streamlining business registration, simplifying tax procedures, e.g., through digitalization, and improving contract enforcement contribute to a more favorable business climate. These efforts are reflected in the Philippines' performance in global competitiveness rankings, signaling progress in addressing long-standing structural impediments. Economists analyze the impact of these reforms on transaction costs, investment decisions, both domestic and foreign, and the growth of small and medium enterprises, SMEs. While progress has been made, challenges remain, including reducing red tape further, ensuring policy consistency, and addressing corruption. Sustained efforts in this area are essential for translating macroeconomic stability into microeconomic dynamism and fostering a more competitive private sector. Beyond the broad drivers, a closer look at specific sectors reveals areas of resilience and potential for future growth, contributing to the overall positive outlook for 2025. The tourism sector, severely impacted by the pandemic, has demonstrated a robust recovery. The expected arrival of over 8 million foreign tourists in 2025 signifies a return to pre-pandemic levels and highlights the sector's enduring appeal. This recovery is supported by improved airport infrastructure, targeted marketing campaigns, and the lifting of travel restrictions. Tourism is a significant source of foreign exchange, generates substantial employment, particularly in regional economies, and stimulates growth in related industries like hospitality, transportation, and retail. Analyzing the tourism sector involves assessing its contribution to GDP and employment, its vulnerability to external shocks, e.g., global health crises, geopolitical events, and the need for sustainable tourism practices to preserve natural and cultural assets. Investment in tourism infrastructure beyond major hubs and diversification of tourism products are key for maximizing its long-term economic benefits. While agriculture's share of GDP has declined over time, it remains crucial for food security, rural livelihoods, and as a source of raw materials. The sector faces significant challenges, including vulnerability to climate change, low productivity, and fragmented value chains. However, there are emerging opportunities driven by increased investment in agri-tech, smart irrigation systems, and vertical farming. Government support for rice production, aquaculture, and rural cooperatives aims to boost output and improve farmer incomes. Economists analyze the agriculture sector's productivity trends, the impact of climate change on output and food prices, and the effectiveness of government support programs. The adoption of technology and the development of more efficient value chains are critical for enhancing the sector's resilience and contribution to inclusive growth. The Philippine manufacturing sector, while historically lagging behind some regional peers, is showing signs of a gradual revival. Key subsectors like electronics, semiconductors, and auto parts continue to be important export earners. The development of industrial zones and export processing areas across the country provides the necessary infrastructure and incentives for manufacturing firms. Global supply chain reconfigurations are also creating potential opportunities for the Philippines to attract manufacturing investments. Analyzing the manufacturing sector involves assessing its competitiveness, labor costs, energy costs, logistics, its integration into global value chains, and the potential for moving up the value chain into higher value-added activities. Policies aimed at improving infrastructure, providing targeted incentives, and developing a skilled manufacturing workforce are crucial for sustaining this revival and creating more high-quality industrial jobs. Despite the positive outlook for 2025, the Philippine economy is not immune to risks and faces significant structural challenges that could temper its growth trajectory. A comprehensive analytical review must account for these potential headwinds. As an open economy with significant trade linkages, the Philippines remains vulnerable to shifts in the global trade environment. Ongoing tensions between major economic powers, the rise of protectionist policies, and disruptions to global supply chains can impact export demand and import costs. Geopolitical instability in various parts of the world can also affect commodity prices, shipping costs, and investor sentiment. Economists analyze the Philippines' trade structure, its dependence on key export markets and import sources, and its position in global value chains to assess its vulnerability to these external shocks. Diversifying export markets and products, enhancing supply chain resilience, and pursuing trade agreements are strategies to mitigate these risks. The Philippines' geographic location makes it highly susceptible to natural disasters, including typhoons, earthquakes, and flooding. These events cause significant economic damage, disrupt supply chains, displace populations, and strain public finances through increased relief and reconstruction costs. A series of destructive storms, as noted in late 2024, can have a measurable negative impact on GDP growth. Analyzing climate vulnerability involves assessing the economic costs of natural disasters, the effectiveness of disaster risk reduction and management strategies, and the need for climate-resilient infrastructure and agricultural practices. Investing in climate adaptation and mitigation is not just an environmental imperative, but also an economic necessity for long-term sustainable growth. While robust remittance inflows and BPO revenues provide support, the Philippine peso remains susceptible to volatility driven by global financial market conditions, changes in interest rate differentials, and shifts in investor sentiment. Significant depreciation could fuel inflation through higher import costs, while excessive appreciation could hurt export competitiveness. The government's external debt, while currently assessed as sustainable by rating agencies, requires careful management. Rising global interest rates increase debt servicing costs, potentially crowding out other essential public expenditures. Economists analyze the drivers of peso volatility, the BSB's foreign exchange intervention strategy, if any, and the structure and sustainability of public debt. Maintaining fiscal discipline, enhancing revenue generation, and managing borrowing costs are crucial for ensuring debt sustainability and preserving macroeconomic stability. Beyond immediate risks, the Philippines faces deep-seated structural challenges that could constrain its long-term growth potential and the inclusiveness of its development. High levels of income inequality persist, limiting the broad-based impact of economic growth. The quality of education and healthcare requires significant improvement to build a skilled and healthy workforce capable of competing in a knowledge-based economy. Governance issues, including corruption and bureaucratic inefficiencies, continue to pose impediments to investment and effective public service delivery. Addressing these structural challenges requires sustained policy effort and institutional reforms. Investing in human capital, strengthening governance institutions, and implementing targeted programs to reduce poverty and inequality are essential for translating economic growth into shared prosperity and ensuring the sustainability of the country's development trajectory. In 2025, the Philippines stands out as a compelling economic narrative in Asia, driven by a confluence of robust domestic demand, resilient external flows, strategic infrastructure investment, and supportive policy frameworks. The analytical consensus among institutions like the ADB, IMF, and Fitch Ratings underscores a period of strong, stable growth, positioning the country favorably within the regional context. The dominance of consumption, the stabilizing role of remittances, the dynamism of the services sector, and the catalytic effect of infrastructure spending form the core pillars of this performance. Furthermore, proactive monetary policy, digitalization efforts, and improvements in the business environment have created an enabling ecosystem. However, for economists, the critical question extends beyond the current growth spurt to its sustainability and inclusiveness. The analysis reveals inherent vulnerabilities to global economic shifts, climate risks, and financial market volatility. More fundamentally, addressing long-standing structural challenges related to inequality, human capital development, and governance is paramount. Translating the current growth momentum into lasting, broad-based prosperity requires continued vigilance, strategic policy implementation, and a commitment to deep-seated reforms. The trajectory of the Philippine economy in the coming years will depend on its ability to navigate external headwinds while simultaneously strengthening its internal foundations. If successful, the potential for the Philippines to solidify its position as a dynamic and resilient economy in Southeast Asia is significant. To gain deeper insights into these dynamics and their implications for investment and policy, subscribe to our economic analysis reports. Engage with our research team for tailored briefings on the Philippine economy. Share this analysis with your network to foster informed discussion on Asia's rising economic players.